I'm in the process of moving from an LLC to an S Corp, and the reason for that being that I just acquired some new property and its tax advantages. My accountant actually recommended it for me.
Northern Initiatives is committed to entrepreneurs like you because you are the people who are creating jobs and enabling the communities of our region to thrive. After completing this course, you will be able to identify general characteristics, advantages and disadvantages of each of the organizational types for small businesses.
The organizational type you choose for your business, sometimes called a legal structure, can impact your taxes and income. Some common organizational types are sole proprietorship, partnership, general partnership, limited partnership, and limited liability partnership, limited liability company, or LLC, C corporation, S corporation. A one-owner company generally has three choices of legal structure: sole proprietorship, corporation, or an LLC. When two or more persons operate a business for profit as co-owners, the one organizational type that is not available to use is sole proprietorship. As a business owner, you should match a legal structure to your business considering 5 key factors: taxation, liability and risk, management, continuity and transferability, expense, and formality. Taxation. A legal structure determines how you or your business is taxed. For 4 of the common organizational types, sole proprietorship, partnership, LLC, and S corporation, the business as an entity does not pay taxes. Rather, profits and losses from the business pass through to the owner or owners and are reflected on the personal tax return or returns of the owner or owners. Taxes are also reported on the owner's tax returns. Only C corporations as a business entity pay taxes. Liability and risk. The liability and risk to which you are exposed when starting a business can generally be categorized as person or property, contractual. Legal structures determine who or what entity is legally responsible for liability for judgments if there is a successful lawsuit against the business. In particular, judgments against a business could result in the owner being held personally liable to pay for damages. All of the owner's personal assets, including the owner's house, could be seized to pay a judgment. New business owners commonly misunderstand liability factors and assume they always need to incorporate to protect themselves from liability. Insurance and well-written contracts can help manage risks to business owners. Management. Each legal structure has its own decision-making authority, continuity, and transferability. This factor refers to how a business persists and how the business is sold to new ownership. Expense and formality. Expenses, complexity, and legal responsibilities differ between the different types of business structures. What organizational factors have the most impact on your business? A sole proprietorship is a type of business entity that is owned and run by one individual and in which there is no legal distinction between the owner and the business. In other words, the business is one and the same as the owner. The sole proprietorship is the common form of legal structure for small businesses. Taxation. A sole proprietorship has pass-through taxation. The business itself does not file a tax return. Rather, the income or loss passes through and is reported on the owner's personal tax return. Sole proprietors often need to make quarterly estimated tax payments. Liability and risk. The owner of a sole proprietorship has unlimited personal liability for any liabilities incurred by the business. You can manage much of this risk with insurance and sound contracts. Management. Control of a sole proprietorship belongs entirely to the owner, who also assumes the full risk of the business. Continuity and transferability. A sole proprietorship lasts as long as the owner is alive and operating the business or until the business is sold. The owner can also sell business assets as well as transfer the business to a family member, usually through the estate planning process. Expense and formality. The sole proprietorship is the simplest way of doing business. The costs to create a sole proprietorship are very low and very little formality is required. A sole proprietorship may be an appropriate form of business for many small and startup business ventures. A general partnership is an association between 2 or more people in business seeking a profit. Like a sole proprietorship, partnerships have pass-through taxation and owners are personally liable for the debts of the business. General partnerships can be created with little formality, but because more than one person is involved, a written contract stipulating the terms of the partnership called a partnership agreement should be created. Taxation. Like a sole proprietorship, a partnership is a tax reporting entity, not a tax paying entity. A partnership must file an annual information return with the U.S. Internal Revenue Service, or IRS, to report the income and losses from its operations, but it does not pay federal income tax. A partnership passes through any profits or losses to its partners, which are divided based on the partnership agreement. Each partner includes his or her share of the partnership's income or loss on his or her tax return and may need to make estimated tax payments quarterly. Check with your state government for fees or taxes the state may charge partnerships. Liability and risk. Owners of a general partnership have unlimited personal liability. In general, each partner is jointly liable for the partnership's obligations. Joint liability means that each partner can individually be held responsible for the entire amount of an obligation of the partnership. However, as with the sole proprietorship, insurance and quality contract design can protect the partnership against most risks. Management. Partners have equal management rights unless otherwise stipulated in the partnership agreement. Continuity and transferability. A partnership exists as long as specified in the partnership agreement. The partnership agreement will determine the consequences of a partner dying or leaving the business. Expense and formality. Again, general partnerships are similar to sole proprietorships in their legal creation and maintenance, and thus have low expense and legal formality. New potential partners should create their partnership agreement with the help of an experienced attorney and accountant. Limited partnerships, or LPs, and limited liability partnerships, LLPs, are two other organizational options for two or more people who plan to maintain a business for profit. Restriction may apply regarding eligibility for the LLP structure. Taxation. The tax treatment for LPs and LLPs is similar to general partnerships as discussed earlier. Profits and losses are passed through to the partners so the partners can reflect them on their individual tax return. Liability and risk. With the limited partnership structure, liability varies depending on the type of partner. A general partner has unlimited personal liability. The general partner is responsible for the everyday operations of the business. Limited partners are personally liable only up to their personal investment in the partnership. The limited partner must maintain a limited role in the day-to-day administration of the business. Legal counsel can advise what, if any, activities are permissible for a limited partner. With a limited liability partnership, personal liability for partners may be limited, but the rules vary considerably from state to state. Expense and formality. Unlike a general partnership, the creation of a limited partnership or limited liability partnership requires a filing, possibly including the written partnership agreement, with the state. An LLC is similar to a corporation in some ways, while similar to a general partnership or a sole proprietorship in other ways. An LLC is considered a type of unincorporated association, not a corporation, even though it is a business entity. Similar to a corporation, though, owners have limited personal liability for the debts and actions of the LLC. Other features of LLCs are more like a partnership, including the benefit of pass-through taxation and greater management flexibility in allocating profits. Owners of an LLC are called members. Since most states do not restrict ownership, members may include individuals, corporations, other LLCs, and foreign entities. An LLC can have any number of members. Most states permit an LLC with only one owner called a single-member LLC. To form an LLC, you file documentation usually called Articles of Organization with a state agency, pay a filing fee, and create an LLC operating agreement which sets out the rights and responsibilities of LLC members. Taxation. Like a sole proprietorship or a partnership, an LLC is not considered separate from its owners for tax purposes. Instead, an LLC is what the IRS calls a pass-through entity. Business income passes through the business to LLC members who report their share of profits or losses on their individual income tax returns. Each LLC member may be required to make quarterly estimated tax payments. The LLC business files only an informational tax return. Traditionally, a trade-off has existed between liability and taxation. However, S corporations and LLCs have changed this dynamic to the point where a business owner can now have limited liability and pass-through taxation. Liability and risk. Like owners of a corporation, all LLC owners are protected from personal liability for business debts and claims, a feature known as limited liability. If a business with limited liability owes money or faces a lawsuit, only the assets of the business itself are at risk. Creditors usually cannot reach the personal assets of the LLC owners except in cases of fraud or illegality. To avoid personal liability exposure, LLC owners should not use a personal checking account for business purposes and should always use the LLC business name rather than the owner's individual names when working with customers. Management. The operating agreement for an LLC sets forth how the business is managed. The owners of most small LLCs participate equally in the management of the business. This arrangement is called member management. Alternatively, members can designate one or more owners or even an outsider to take responsibility for managing the LLC. Non-managing owners, such as family members who have invested in the company, share in LLC profits or losses without participating in the direct management of the LLC. Continuity and transferability. LLC members, somewhat like partners in a partnership, cannot transfer their ownership. In most circumstances, an LLC does not possess continuity of life and is usually dissolved upon the death or retirement of any member. Some states require an LLC's operating agreement to set the limit of the company's existence to 30 years. Also, states may require majority or even unanimous member consent to transfer ownership to a new member. Expense and formality. One disadvantage of forming an LLC instead of a partnership or a sole proprietorship is that you pay a filing fee, ranging from $100 to $800 when you submit your articles of organization. On the positive side, articles of organization are short, simple documents. Even though an operating agreement may not be required by your state law, you should create one anyway. An LLC operating agreement sets out rules for the ownership and operation of the business, much like a partnership agreement or corporate bylaws. Also included in operating agreements are buy-sell provisions, which determine what happens if a member wants to sell an interest in the company or when a member dies or becomes disabled. A corporation is a legal entity that is separate and independent from the people who own or run the corporation. This means that the corporation itself, not the shareholders that own it, is held legally liable for the actions and debts incurred by the business. As a corporation, it has privileges such as the ability to enter into contracts, but it also has certain responsibilities such as the payment of taxes. Corporations are more complex than other business structures. There are also potentially costly administrative fees to create and maintain a corporation, as well as more complex tax and legal requirements. Most businesses do not need to incorporate. Corporations are generally suggested for established, larger companies with multiple employees, or when certain other factors apply, such as a corporation that sells a product or provides a service that could expose the business to sizable liability. Forming a C and an S corporation is similar. For both, you file articles of incorporation with your Secretary of State or, with some states, your state's corporations division. Filing articles of incorporation will usually cost no more than a few $100s in fees. While the contents of articles of incorporation vary from state to state, most will establish company name, purpose, stock quantity and price, and corporate officers. Only after the articles of incorporation are filed and accepted by your state does the corporation acquire legal existence. Once incorporated, the board of directors meets for the first time, followed by at least one annual meeting per year. The board of directors appoints officers who conduct the business of the corporation. Management. A corporation's overall management is vested in the board of directors chosen by the shareholders. The officers handle the business's day-to-day affairs under the board's general direction. In small corporations, the managers, owners, and the board of directors are often the same people. In larger corporations, those three roles can be held by different people. For example, corporate boards often place day-to-day management decisions in the hands of a chief executive officer, or CEO, who may also be a board's chairman or president. The CEO supervises other executives, such as vice presidents and the chief financial officer, chief operating officer, and chief information officer. Continuity and transferability. The independent life of a corporation makes possible its continuation and the relatively undisturbed continued operation of the business, regardless of incapacity or death of one or more stockholders. The corporation as a separate legal entity does not cease to exist if one or more of its owners die. A business's corporate existence lasts as long as its shareholders decide the corporation should exist. Corporations can last for decades through multiple generations of owners. Ownership of a corporation can be transferred by sale of the stock. Additional owners can be added either by the corporation selling stock or by current owners selling some of their stock. Expense and formality. Corporations are more complex entities to create, have more legal and accounting requirements, and are more complex to operate than sole proprietorships, partnerships, or LLCs. Investors are more easily attracted to corporations, but more complex ownership, reporting, and management requirements go along with this advantage. Disadvantages also include having to hold regular meetings of directors, keeping records of corporate activity, and maintaining the corporation's ongoing financial independence. The C corporation, also known as a regular corporation, is the most common form of business entity for larger companies. Remember, C corporations, as a distinct legal entity from their owner, have several distinguishing characteristics including limited liability, easy transferability of shares, this is ownership, and perpetual existence. They also have a centralized management structure that may be different people than the owners. Taxation. In a C corporation, the company itself is taxed on business profits. The owners pay individual income tax on money they receive from the corporation as salary, a bonus, or as dividends. Double taxation is an issue with C corporations since profits taxed at the corporate level are taxed a second time at the personal level as dividends. Liability and risk. S corporations and C corporations offer the same limited liability. Management. Management and ownership structures are the same for both S corporations and C corporations. Continuity and transferability. C corporation and S corporation owners are shareholders. A corporation exists for as long as shareholders decide the company should exist. Ownership is transferred by the sale of stock. Expense and formality. The owners of C corporations and S corporations must follow similar requirements. In addition, a C corporation files its own tax returns. An S corporation is a regular corporation that is elected S corporation tax status. Forming an S corporation lets you enjoy the limited liability of a corporate shareholder, but you pay income taxes as if you were a sole proprietor or a partner. An S corporation is formed by making a Subchapter S election when forming a C corporation. To create an S corporation, you must first create a regular corporation with your Secretary of State's office or your state's corporations division. Then, to be treated as an S corporation, all shareholders must sign and file IRS Form 2553. Taxation. This is the major difference between an S corporation and a C corporation. In an S corporation, all business profits pass through to the owners who report them on their personal tax returns, as with sole proprietorships, partnerships, and LLCs. The S corporation itself does not pay any income tax, although an S corporation with more than one owner must file an informational tax return. Writing a business plan is the best first step in determining your business's organizational structure. Your business plan will describe key factors impacting your business, such as market, sales volume, management structure, location, marketing strategies, financing. In addition, some of the questions to answer before deciding on a structure include: who will own the business? Who else is involved with the business? Is this a partnership? Who will manage the business? Does your product or service carry significant liability risk? How much financing does your business require? Will you have outside investors? What is the sales growth potential? For many owner-operators of small businesses, the sole proprietorship is the right organizational choice. A partnership might be the right choice for a business with multiple owners. Owners of businesses that sell products or provide services with significant liability risk should consider an LLC or S corporation. A C corporation would probably be the best choice for large ventures with multiple owners and complex financing. Get advice from an experienced business attorney. You'll also find a wealth of information on the websites for the IRS and Small Business Administration, or SBA. Which organizational type will be right for you and your new business? The organizational type you choose for your business impacts how you own the business, how you or your business pays taxes, how you get paid, and other important factors. As a business owner, you match a legal structure to your business considering 5 factors: taxation, liability and risk, management, continuity and transferability, expense and formality. Writing a business plan is the best first step in determining an organizational structure for your business.
I started my business as an LLC, just myself, and I've never thought yet to take on any kind of partnership or any other kind of corporate identity. Later on, who knows, if I ever have other stores or franchise. I mean, with my type of business, the possibilities are endless. But right now, I plan on staying the LLC, and that has worked well for me.
We realize the success of your business directly impacts the success of your community and its people. So we push a little harder and we care a bit more because it's not profit for us, it's prosperity for all.